And now, taking things forward, time now for us to move towards the next very interesting segment lined up. As you all know, that as a part of the Legal Era 7th Insolvency and Bankruptcy Summit, we're looking at very important dynamics. Now, in this panel discussion that's going to be on IBC and financial service providers, we're delighted to have amongst us our distinguished panelists as well as the speakers. We welcome Anoop Rawat, partner Shardul, Amarchand, Mangaldas. Welcome, Anoop sir. Anoop sir is a partner with the firm and has over 15 years of experience. His focus areas include insolvency, bankruptcy, projects, banking and finance. He has represented clients across a wide spectrum, including resolution professionals, committee of creditors, resolution applicants, amongst others. Welcome, sir. Sir, allow me to introduce the speakers for the session. We're delighted to have amongst us Sumit Khanna, partner and national head of corporate finance and restructuring at Deloitte. Sumit heads both the corporate finance and restructuring service verticals for Deloitte in India. He has built the bankruptcy and insolvency practice from the scratch and has helped steer not just the management and operations of some of the largest and most complex cases in the country, but also helped in getting them a suitable resolution. He leads and manages the key banking relationships for the firm. Welcome, sir. We welcome David Shiu, partner and founder, DHC Capital. David has over 24 years of experience in restructuring, turnaround, and special situations. David has worked with and advised private and publicly listed corporates, bank creditors, bond holders, amongst others. David has also been involved in high-profile and complex transactions across Asia Pacific and has been involved in several groundbreaking firsts in the restructuring in the region. As an investment banker, David was involved in the sourcing, structuring, and execution of high-yield, stress-distressed investment opportunities across Asia Pacific for Morgan Stanley, Prop Books, amongst others. Welcome. We welcome Prashanth Venkatesh, Managing Director and Head of Credit Restructuring, Broad Peak Investment Advisors Private Limited. Prashanth is primarily and principally involved in structuring investments and mitigating risk in distressed credit and special situations, and he has advised banks and financial institutions in financing, refinancing, amongst others. Qualified both in India and England and Wales, he has significant experience in Indian financing transactions, assisting sponsors negotiate, acting for lenders on debt restructurings. Welcome. We welcome Devesh, Malviya, Director at Deutsche Bank AG and Head of Credit Sales Desk for the bank, covering both debt syndication as well as origination, trading of illiquid special situations. And Devesh is a finance professional with over 2 decades of experience across multiple geographies. So on that note, a warm welcome once again to all our distinguished panelists, our speakers, and I would request our moderator, Anoop Rawat, partner Shardul, Amarchand, Mangaldas Incorporation, to take the deliberations forward on this wonderful afternoon here, a virtual afternoon here at Legal Era 7th annual 7th Insolvency and Bankruptcy Summit, requesting Anoop Rawat to begin deliberations for IBC and financial service providers. Mr. Rawat, please begin the deliberations.
Thank you, Amna, and very warm welcome to all the participants and the panelists here. Mindful of the time that is available with us and the hard stop that our panelists have. So before starting the questions, a very brief introduction to this whole session. We all know that there was a specific exclusion in the Bankruptcy Law Reforms Committee report, and that was for the financial services providers. One of the reasons that was cited in the BLRC report was that a resolution mechanism is going to be introduced under the Indian Financial Code, which was recommended by the Financial Sector Legislative Reforms Committee. This exclusion was carried into the IBC, but with an enabling provision under Section 227 of the Code, where the central government was authorized to introduce the insolvency regime to the identified financial services provider. While it was never the intent that the insolvency code would also be applied for the financial services providers insolvency, but with the downfall of ILNFS, followed by Diwan Housing, the government was forced to introduce the provisions of insolvency to the financial services provider. In the press statement by the then Secretary, Ministry of Company Affairs, Mr. Injiti Srinivas, he stated that this is introduced by way of expediency, and this is meant to be an interim arrangement only, pending a detailed mechanism for the FSPs. The present regulatory framework is contained under Section 227, read along with the FSP rules that have been introduced by central government. So today we'll be discussing in this session about the efficacy and adequacy of the FSP rules. We'll also be discussing the problems that we are facing on its implementation and the potential solution that can be worked on it. Now we have several companies which are of substantial size, which are in the insolvency today, where a lot of problems are faced. So I'll be asking questions to the distinguished panelists. My request would be that each panelist restrict their response to the questions to 4 minutes each. At the end of the session, we will also be having a very brief Q&A session, if the time allows. So to begin the session, the first initiation point for the FSP is the determination by the Reserve Bank of India for the initiation of the insolvency process, and then filing the application before the adjudicating authority, which is the Honorable National Company Law Tribunal. The first question to Sumit, and then I'll follow it up with the other panelists, is that given the huge number of NBFCs that we have today, more than 9,500, and also given the fact that there is no mechanism today as to how RBI makes the determination, Sumit, do you think that the current mechanism that allows only the Reserve Bank of India to make a filing before NCLT is an adequate mechanism?
Thanks, Anoop. And firstly, thanks for having me over on this conference. It's an absolute pleasure. It's a very interesting question. And, I was just reading recently this article which referred to the ex-Fed chairman, Ben Bernanke, about how it is not necessarily true that you only have a run on a bank as a consequence of a recession, but how a run on a bank can indeed lead to a recession also. So I think there is some merit in the exclusion of FSPs from the course of normal admission to insolvency. But that said and done, I think India again is unique in many ways, including in the way we have a shadow banking system through these NBFCs. And clearly, the NBFCs are not as well regulated as the banks, and they are large in number. So delayed admission of these NBFCs invariably can lead to a lot of pain for the financial creditors who are there in these NBFCs. So yes, there should be a separate treatment, but clearly I think the regulator today is constrained in terms of being able to consider all the appropriate inclusions that should be there in terms of bringing to insolvency the NBFCs. So we need to find an alternate mechanism by way of which there can be more frequent admission, because frequent admissions will lead to self-regulation and correction in the sector also, as we've seen in other sectors.
Thanks, Sumit. Prashanth, you have been into some of the insolvency. I don't want to go into the specifics of these insolvency, but clearly, as as someone who has been closely associated with these processes, what's your view on this particular issue, especially given the fact that there have been cases where RBI have delayed in referring the matters to the insolvency?
Thanks, Anoop, and thanks, Legal Era, for having me here. I appreciate this opportunity. I think there are two critical points. One that's already been touched on by Sumit, which is the time value of money. Surprisingly, in the context of financial institutions, the negative theta is even more aggravated than normal manufacturing entities. If I, as the lender, and please remember that this person is already, the FSP is the lender in this example that I'm discussing. If I, as a lender, am going through my own credit processes, bankruptcy processes, basically dealing with my creditors, chances are my management bandwidth isn't really looking to go back and start asserting the rights that I, as a lender, have against my borrowers. And that, I think, is the critical issue. That's why there is an exacerbated effect of time value of money in the context of financial sector insolvencies generally, and therefore there is a need to move quicker. That way you put the borrowers on notice that just because this entity is going through its own restructuring process, insolvency process, that doesn't mean people have taken their eyes off the ball. I think that's a critical point. And then the second important point that I want to make is the fact that there is a consequence of a delayed admission into an insolvency process. And the consequence of the delayed admission into an insolvency process, of course, we will be touching on this a little later as well, is the fact that your entire fraudulent conveyancing, those transactions have a later in point in time look back period, where the regulator is taking its time to make a decision whether to put a company into an insolvency process or not for larger reasons than just simply a financial issue as to whether the company has repaid its debts. Then I think the creditors need to be kept whole for that duration which the regulator is taking. So that'll be my 2 points with respect to your question. Thanks.
Thanks, Prashanth. Devesh, as a banker, where do you think the problem lies, especially from a perspective of your ability to approach the regulator for resolving of the debt? Where do you think the problem lies in initiating the FSPs, and where do you think that the RBI can perhaps develop a more detailed mechanism to address the issues of delay?
Thank you, Anoop, and thank you, Legal Era, for having me here. It's really a wonderful opportunity. And coming back to your questions, I think both Sumit and Prashanth have touched upon various relevant points relating to this. So financial services obviously is more complex than any other industry that goes through the IBC process, and globally we have seen different regulations for FSPs particular compared to the other aspects of economy. I think the time value of money and the point that we will obviously touch upon the avoidance kind of transactions. These are the ones which really get impacted in the delay of application by the regulator itself. And also given the fact that there are a number of different kind of legal entities, it's not just banks, but different kind of entities that are involved in the ecosystem, be it insurance, be it the asset managers and all. I think there needs to be a much more quicker and comprehensive arrangement entered upfront to make a company enter insolvency process. The delays, I can understand from a regulator standpoint because there are multiple stakeholders. Even from a deposit. From a deposit taking NBFC to a non-deposit taking NBFC, and there is a chance of a systemic risk. There could be bells and whistles in the process in terms of who can possibly approach or initiate insolvency process. But for all practical purposes, I think the creditors need to have a much larger say, the financial creditors, in terms of initiating a process like this, because the longer the delay, it's going to impact the overall process and the recovery to the creditors.
Thanks, Devesh. David, very quick question to you. You have massive experience, in providing the rescue finance. How important do you think is the certainty of the process for somebody who has to provide a rescue finance to the ailing financial entity?
Yeah, it's very important. Without the certainty, the investors are going to be wary or have some concerns about whether the transaction can be completed. And we've seen that a little bit in some of the schemes that have gone through here, where the shareholders actually have, where we do schemes and there's issuance of shares, we see that the final step, which is the EGM for shareholders, that has actually given some concerns as to whether the shareholders will agree, especially if they're being heavily diluted. And one of the things that we have been trying to put forward to the authorities here is whether or not, as they are out of the money creditors, should they be treated like, as they are out of the money stakeholders, as in the equity position, should they be treated the same way as out of the money creditors and in effect be crammed down? So that is something that we are putting forward, but it is a concern that we face here, and it's something that we're trying to see the best ways to work around it.
Thank you, David, for this quick comment. This first question, I would conclude with a statement that while RBI is identified as the regulator to initiate the insolvency, but at the same time, there has to be a definite timelines within which RBI need to initiate the process in order to safeguard the interests of the stakeholders. Right now, that is absolutely lacking in the code and the regulation and rules. Moving on to my next question is again, related to this issue of regulator. Now, we know that Section 227 empowers the central government to bring out the rules for identification of the financial services provider for whom the insolvency will be initiated. What is interesting is that the code itself provides the definition of financial services regulator, which includes not only the RBI, it includes SEBI, it includes insurance regulator, it includes the provident fund regulator. But interestingly, when the rule came out, not only that the central government defined the financial services provider for which the insolvency can be initiated, but it also surprisingly defined the appropriate regulator. Now, that appropriate regulator is defined only as Reserve Bank of India. Now, that does create some kind of a conflict between what the code says and what the rules have introduced. And especially in the context of the financial entities, where they may not have interface only with the RBI, they may also be running insurance business, they may also be running some businesses which has an interaction with the other regulators. Now, in this context, my first question to Prashanth, how do you see this regime which limits only RBI as the appropriate regulator without looking at the coordination issues amongst the different kind of regulators which have interface with an insolvent company? Prashanth, you are on mute.
It seems that the central government has actually empowered the RBI to be the lead regulator to coordinate the processes and thereby make a reference, obviously looking to the sectoral regulator for guidance. I think there is a little bit more, there's also some element of the fact that the other sectoral regulators, for instance, insurance funds, there is only so much that can go wrong because of the significant regulatory limits that are imposed on insurance funds, both in terms of debt investments they can make, the kind of investments they can make in terms of, the short-term nature of their current investments. And they can only take very limited amount of debt on their balance sheets. So maybe there is that thinking that, look, some of these sectors have certain inbuilt safeguards. And in the context of NBFCs, where the entire play is just net interest margin, I mean, I borrow from you at X and I lend to somebody at X plus 300 basis points. There, this issue becomes more aggravated. So I suspect that it's more a priority issue that the central government has done, and maybe they haven't really considered it. But if I were to make a hazard, I'd hazard a guess that it is because of the fact that the RBI is empowered to coordinate and gather views before it actually puts another sectoral entity into an insolvency process.
Thanks, Prashanth. Sumit, it is understandable why a central government would identify one regulator, because if you have identified multiple regulators, it sort of initiates a turf war amongst the regulator, and the objective is lost. But do you think that it is appropriate to identify just one regulator, even for the purposes of the one example could be the fit and proper, or the no objection from a perspective of acquisition of companies which have interface with the other regulators as well. Do you think that this identification is appropriate?
So, Anoop, the interface is something which will need to be set up by the regulator and undertaken appropriately. But what is interesting in the Indian cases, our holding companies, which are CICs, okay, invariably may end up being in an insolvency situation. Whereas they are in insolvency, the underlying assets may not be, and the underlying assets may be governed by a different regulator. So CIC is like akin to an NBFC is governed by RBI, and that's where the dichotomy arises. So I think you're very, very, very right that whenever you're talking about this FSP guidelines and RBI is put on point, it is unfair also to have RBI on point when the underlying asset is governed by another regulator. A prime example would be, say, for example, what happened in DHFL. So RBI consented to the plan or gave its nod. It went through to the adjudicating authority. But still, IRDAI was not consulted in terms of the underlying insurance business, which was one of the many businesses owned over there. So, these complications will keep coming up, and there needs to be effective coordination between the regulators. There should be a mechanism which suggests that upfront this consultation between regulators should be there. It should not be left to the advisors and the administrator to be running helter-skelter and going back and forth between the various regulators. I think that is very, very important. At the same time, you will need to have a point, and I think RBI can effectively play that point, given that almost in every case, their relevance is there, whilst other regulators may also be important.
Yeah, thanks, Sumit. Devesh, what do you think? What do you think that what could be the optimal solution to ensure that there is a coordination amongst the various regulator? What could be the various coordination mechanism that could be brought in the rules, perhaps, which resolves this issue of uncertainty of the the regulator stand?
So fortunately, Anoop, I think whatever default situations and the cases that we have at hand are for companies that are primarily regulated by RBI only. It's the underlying operating companies which are governed by different regulators. We're talking of insurance companies regulated by IRDA that are a part of the performing companies within the same portfolio of the ultimate NBFC that has defaulted. So while there are regulatory caps in terms of, say, investment into X company, X asset that needs to be monetized as part of the resolution, it has so far not been the minor. There could be a minor one or two cases, but I don't think it has been an insurmountable challenge. And so far, the regulator and the administrator have been able to harmonize this. But yes, I agree that there could be a central regulator or there could be a coordinating body sitting within that. I think IBBI does that soft role currently. But a defaulting financial institution is a serious enough matter that people at least turn up for the meetings. So the issue that we are all grappling with is it comes to the need to protect regulatory turf. And this, I feel, can only be solved by legislation.
Yeah. Thanks, Devesh. We have seen internationally some solutions have come up. For example, Financial Stability Board, which was constituted by the G20 group countries, they do prescribe a mechanism of coordination amongst the regulator. David, in terms of your business of providing rescue financing to the ailing companies. Especially in a context where the rescue financing is needed for the operating companies, but the the actual company in a stress or in insolvency is the holding company. How much regulatory certainty you think would definitely be needed for you to look at rescue financing in these kind of cases?
Well, we would look at the fundamental position in terms of the credit profile of the subsidiary. If the borrower would be the subsidiary, would look at that entity first and foremost. So what assets it would have, what cash flows it would have, potentially what security it would be able to make available. If there were to be additional guarantees and other elements that come from the top company, we would also look at that entity in a similar sort of manner. But we would look at them each individually as a standalone entity to make an assessment as to whether we want to commit some capital to that entity. And then we would also look at the tools available, like in the regimes. So for example, in Singapore, we have a super priority regime, which is court-backed, which can then provide additional security ahead of other creditors. So we would use potentially how those tools could be used, or whether the money would come in the form of taking out some lenders and then coming in with new capital after that situation has happened with the banks and other key creditors.
Thanks, David. Devesh, sorry, you have raised your hand. You have something to...
Sure. I wanted to add on to this. So, when it comes to rescue financing and priority financing, first of all, in a country like India, there haven't been too many instances, even in the broader, sort of economy. There are only 2 points that I would want to make in terms of enabling rescue financing. First of all, it has to be black and white, and the creditor should be able to decide its own fate. Essentially, what it means is outside IBC priority arrangements are generally subject to legal challenges. So you need to have a rule that kind of puts it in black and white. So the new money lender is going to come after the money has gone bad, or somebody who throws the good money after the whole bad debt has come up needs to be protected accordingly. Secondly, since the size of this debt is not going to be very large compared to the overall debt kitty that you have, this will be a smaller percentage of total claims. It doesn't have the ability to vote on decision. So what I said in terms of it being on black and white and being able to decide its fate, the law needs to protect it adequately, as well as give it its duty in terms of deciding on resolution path to help a company come out of IBC.
Thanks, Devesh. Our regime is definitely, insofar as the rescue finance is covered, is at the nascent stage. But at the same time, rescue finance is very critical, especially for an FSP which has a systemic risk issues, and there would definitely be a need for a continuity of operations. David, basis your experience in Singapore, what kind of a structure, basic structure that you would want to see in any insolvency mechanism which motivates the rescue financing in the country?
Yeah, sure. So in Singapore, we have new legislation that came in about 5 years ago, originally through the Companies Amendment Act, but then was incorporated into what we call IRDA, which is the Insolvency, Restructuring and Dissolution Act. And the legislation has 4 priorities. So the first level, which is the lowest priority, is treated as part of the costs and expenses of the winding up. The second level is priority over all the preferential debts, which is employees, liquidator fees and expenses. The third is security over unencumbered assets. And the fourth, which is the highest, is secured by security that is already pledged to other lenders. So in effect, in the US terminology, that would be called priming. So where we have seen cases in Singapore so far is across the second and third limbs. So ahead of preferential debt and over unencumbered assets. We've seen 6 cases here in Singapore. We've done 3 of the cases, and they have all been primarily done by investors, strategic investors that have been using the super priority to get exclusivity and access to information. So as part of their intentions to ultimately own the company, they provide a little bit of money under the super priority. And then from there, they're then able to then complete a deal or move forward the deal with a larger interest in mind. We haven't seen any in the fourth case, which is priority over existing assets. So in effect, priming over banks. And that would mean going against the bank's valuation fights. But I think that's unlikely anyways. If you look at Chapter 11, these sort of fourth priority cases are typically not really challenged in court. They're typically pre-agreed. The existing lenders typically do it themselves to protect themselves from other providers of finance, or they're called defensive dip. So whether we see anything down into the fourth stage, I think it's unlikely. But I think in terms of the second and third steps here, we've already seen it used in smaller cases so far, and I think that's where there'll be definitely appetite going forward for companies to try and explore this, because it does provide a court order to provide the downside protection for the funds.
Thanks, David. So, we discussed very important aspect during the FSP insolvency. One is the coordination amongst the regulator. Second is the key aspects for the rescue financing. For the on the issue of coordinations among the regulator, we have recognized that there is definitely a need for more coordinations among the regulator. There's also a need for acknowledging that RBI may not be the appropriate regulator for all FSP cases, especially where the FSP is a CIC. It may have the holdings in the insurance businesses where IRDA, SEBI, and other regulators do come in. So an enabling coordination mechanism, either under the rules or under the main statute, is the need of the hour, which will ensure an effective resolution. Similarly, for the rescue financing, David, you have very aptly summarized what need to be the clear parameters for ensuring rescue financing for the ailing companies, the need of priority, for the rescue financing. Quickly moving on to our next question on this topic. We have recently seen that some of the judgments have come where they have undermined the commercial wisdom of the Committee of Creditors, especially in the context of FSPs, which is primarily the loan assets, which are their main operational activity. The decision of the adjudicating authority, where they have allocated the entire realizable amounts from the avoidance transaction to the Committee of Creditors, ignoring the fact that the underlying assets are the loan assets for which the resolution applicants have bid, and might completely change the way they have made the assumption in their plan or their financial modeling. Prashanth, where do you think we will go with this kind of a approach from NCLAT? And to be safe, to be on a safe side, I need to clearly explain that today Supreme Court has put a stay on this order, but the approach itself is very dangerous, especially given that we are in the middle of few insolvency resolution which may have a bearing on this issue.
No, you're absolutely right. I mean, the stay is already in play. But one of the interesting things that the Insolvency Law Committee did when it looked at this specific provision, and it actually debated both sides, right? Whether we give it to the Committee of Creditors or should we actually transfer it to the incoming buyer so that it kind of stays with the corporate debtor itself. And the Insolvency Law Committee took a little bit of time and then said, you know what, we don't need to get too prescriptive around what should happen and let people kind of figure it out themselves. And I think the rules give you that little bit of play until this change had happened. So in a sense, the NCLAT judgment has made it very clear that actually it can only stay with the Committee of Creditors. And I'm not necessarily sure that that's necessarily the correct way of doing it. The reason is simple. The financial services providers over here, we're talking about are NBFCs, loan-giving NBFCs. Usually, this is not a situation where I created a factory and I purchased raw materials not for X, but 5X from my promoter. And I'm not selling the finished products at 5X to my promoter, but I'm selling it at X. It's not one of those kind of very simple mechanics where you can see that there has been some kind of preferential exercise done. Over here, it's actually going to be in the form of loans. Loans that are given, which are either backed by security, which has zero value, or unsecured, but has not really got any credit association in terms of the actual interest rate itself. So in these kind of transactions, the loan asset forms a part of the book of the corporate debtor. So to identify the specific loan assets which are potentially problematic, having those loan assets ring-fenced, and then saying that those loan assets that are identified will be subject to only distribution for Committee of Creditors. Look, as a creditor, that's a great outcome for me. It may not necessarily lead to a clearer outcome in terms of a resolution plan, because at the end of the day, it's the corporate debtor that is running this process, because my resolution professional drops away at some point in time. It's only the corporate debtor that is running the litigation, that is running the recovery processes against each of these loan assets. So to enable a motivated outcome, a negotiated outcome, there could be, for instance, creditors who say, look, you run this process, treat it as if it's your own asset. You get 50% of what we recover. We get 50% of what we recover. There are mechanisms by which creditors and the new resolution applicant can come up with solutions which enable motivation on both sides. I think by having a very hard rule, you kind of militate against those outcomes.
Thanks, Prashanth. Sumit, putting a condition on the determination of various aspects of resolution resolution plan and the commercial wisdom of the creditors, don't you think that creates not only the uncertainty of the process but also undermines the whole resolution effort, which should be driven only by the commercial negotiation between the COC and the resolution applicant?
Anoop, you've touched a very raw nerve. So let me take a step back. I've always been a very big fan of the code as it was originally promulgated. Now, unfortunately, two things have happened. A, there has been judicial overreach, because if you look at it, the way in which the code was written, the judiciary actually has very limited role to play, especially when it comes to approval of a plan. Okay, so there is some very well laid out things that a resolution professional needs to do in terms of checking the plan for compliance, and thereafter it is for the COC to use their commercial discretion to choose which plan they want to go for. And fortunately, there has been more than one instances of the Supreme Court itself ratifying that the commercial wisdom of the COC is final. However, our judiciary is very active, very hands-on, and wants to be more participative, which is unfortunate if you ask me from a legal standpoint. And my apologies for saying this. And that's exactly what you're seeing over here. So whilst Prashanth was kind and he tried to put a explanation or a justification for the whole process, ultimately it's a commercial negotiation. Whether it be a non-FSP process or if it be an FSP process where loans have been fraudulently given out or preferentially given out or not recovered, ultimately whoever is giving the resolution plan has determined what it is worth for him to take over the company. And after that, of course, he's seen if he can make extra money and try and pressurize the creditors into agreeing to what he submitted. Now, if there is no other credible alternative, the negotiation goes in his favor or not, we don't really know what his internal dynamics are. The creditors have agreed and they have passed or approved his plan. Thereafter, nobody has any business of interfering and interceding in that, okay? Because if you are changing the commercial dynamics of the plan, when you say, no, this has to go to COC, why? It is very clear that for all these transactions, if there is any recovery, it will be to the account of the corporate debtor. Now, it's coming to the corporate debtor, and as part of the negotiations, the COC has ceded that benefit will go to the resolution applicant. I think it should end over there. Now, also very pertinent is the point, which is the justification which Prashanth made, that all these claims of preferential, fraudulent, and otherwise transactions, they will never see the light of the day unless somebody puts in time, effort, and money to claim them. And who does that? It is obviously the resolution applicant post the completion of this CIRP process. So, if during a negotiation, and we've seen enough and more examples where during the negotiation, the creditors agree that, look, part of this should come to them, part of it would be staying with the corporate debtor or the resolution applicant post successful resolution. But if that's not the case, I don't see any reason for interference by judiciary. Also, what's happened is because of such interference, we've seen lots and lots of regulations have come around, okay, which have tried to clarify the code, and invariably they are not enabling. What they are doing is they're tying us all up in knots, okay. And whether it be and then from time to time they are also now getting modified a little bit, thankfully. But what is happening is that we are over-regulating, if you ask me, and this is only because unfortunately there has been over-indulgence leading to the law not panning out the way it was supposed to be. And that's all I want to say. So,
apologies. Quick factual points. I just want to say that, in DHFL itself, if you look at the NCLT judgment, they note the fact that, the level was significantly lower and it got bumped up to 37,250 crores. That's actually a part of the judgment. 63 Moons does not get into it. It talks about the need for a commercial point, but it doesn't get into that.
Yes, Prashanth, you are right. You're right. And that is where, I must appreciate the efforts by the Insolvency and Bankruptcy Board of India to introduce a change in the regulation. Now that regulation specifically recognize that the resolution applicants can provide an amount for the avoidance transaction. I hope with that change, now the courts do not interfere in the negotiation process for putting a value to this. Devesh, as a banker, do you agree? Do you agree with the discussion so far? And would you ever be interested in getting into fighting for the realizations after the implementation, or would you want to take a value assigned by the resolution applicant and then do your regular banking activity? Because most of the times after implementation, if you have to fight it out, then it's a cumbersome process for you to be following up with whosoever is fighting against those cases.
So, Anoop, I think we, Sumit and Prashanth have both summarized it well. There has to be a sanctity to the process. We have put a process, and the COC and the members follow it adequately. The courts debate upon it and ultimately decide. If every process needs to be deliberated at the apex court level, then there need not be a process in the first place. If everything has to be decided at apex court level, it's just simply a wastage of everybody's time. And you would have to believe that the due effort was taken to approve a particular plan. Revisiting it again and again not just makes the process harder and complex. It from the perspective of overseas investors who are looking at investing into these stressed assets, there is no timeline in terms of when they can actually see the sight of money on the trade, which really makes it very hard to attract any kind of funding into this sector. So it's something which is complex, because you cannot really stop the judiciary from entertaining multiple PILs, etc. But I think there could be some more commonsensical approach here, because all it makes is the process tardy and lengthy, and which at least the FCs do not want to have in the first place.
Thanks, Devesh. We started with the discussion that this FSP rules on insolvency have been brought in as an interim measure. We know that there was a Indian Financial Code, and there was a commission which was meant to bring the insolvency framework for the FSP in a much broader way. In fact, I had a chance to look at the code provisions and the resolution corporation which was proposed. It's a very elaborate mechanism. I think it's the insolvency of FSP is a very, very complex issue, and many more rules and the coordination mechanism, especially amongst the regulator, need to be introduced. We have many questions here, and we also wanted to take up questions from the the participants. Unfortunately, we are not left with too much time, and I'm very, very conscious of the next important panel discussion on cross-border insolvency. I already see that the panelists have already logged in. So this time, we would limit our discussion to this, and we hope to have much more meaningful discussion around this issue. Thank you so much, all the panelists. Thank you for spending your time today. And we are staying back, at least I'm staying back for the very interesting next session on cross-border insolvency. Thank you. Thank you so much, all.
Thank you, Anoop. Thank you all.
Thank you. Thank you all.
Thank you.
Thank you.
Session that was highlighting some very important dynamics. And yes, now without further ado, let's take things forward for our next session. So